Welcome back at 8:43. Now that we are in 2023, we are taking a closer look at the market's first quarter. Do we see inflation continuing to rise, or will there be a recession on the horizon? Joining us this morning with some predictions for the first quarter is Ernie from Burns Estate Planning and Wealth Advisors. 2023, here we are. It sounds weird.
I know.
Almost,
yeah, we hear. Doesn't feel much different than 2022 at all.
Yeah, and if you look at the stock market, things have kind of been a little shaky too. What do you expect to see here? I mean, it seems like after a year in 2022, when pretty much everyone took a hit across the board, there's only one way up, right? But not so fast.
Well, this first quarter, we're going to have earnings coming in, and some are going to be disappointing. So the first quarter is probably going to be very similar to the last quarter, negative, okay? Or basically we're bouncing off the bottom. However, there are some opportunities right now. Stocks have been priced down much lower and much more fair market. So if you have extra cash right now, you could buy some things on sale for later in the year when they start actually going back up.
I guess kind of what you're saying there is that, we won't pick any sort of brands or companies in particular, but if you have a stock that was worth $100 for a while, and then last year it lost a huge chunk, it's less likely that it'll lose an equivalent chunk?
In general, possibly, as long as it's a good quality stock, that I've said the price functions have come down much more manageable right now, much more priced in. Now, the second and the third quarters, by that time the interest rate hikes will be basically ceased, okay? And inflation will be coming down, as it's been doing this last 6 months in a row. As it comes down more and more, the market's going to be more priced in and be a little bit more bullish.
That's when we say that word priced in, I think that's important to kind of explain to people. Investors expect the market to kind of become more bullish later on in the year. Pricing it in means you don't necessarily wait until that point to start buying, because they're expecting it to be up, and the big gains have already been made.
Let's just use Apple as an example.
Yeah.
Apple has $1 trillion in cash on the side. Just because interest rates are going up, it's not really affecting Apple in the ability to basically produce phones or any parts of or measures of producing new products. That when companies are making a flush of cash and they have incoming cash along with it, and they have that cash on the sidelines, but the stock's been pushed down, 20% already, that's opportunity right there.
Right, and that's kind of what we're looking for here. Hey, let's talk about some folks may be looking at, hey, this is it. This is the last year I'm going to be working, looking forward to retiring. What should they be looking at to make sure that they're in the right situation to have that retirement be a happy one?
Great question. If you're looking at retirement this year or within the next 2 years, you need to be more risk tolerant. In other words, you need to look at how you're investing right now and make sure that you're not too aggressive in this market. Also look at alternative investments. Not everything based just on the stock market in itself. So you have different opportunities. Structured notes this year have done real well when they are built correctly. CD rates have now popped up when you build CD ladders or bond ladders. How things are done normally in the past, it's been such a bull market for the last 10 plus years, you can't invest the same way, especially when you're looking at retirement. You don't have those years coming up that you could basically wait on that money, when that market to come back.
Right.
So alternative investments and a retirement advisor would be more presentable when you retire.
Right, you don't want a potential black swan event like the pandemic or something happening that could tank some of those more risky investments. Maybe something that is a more fixed rate, but not as the return is.
Right. Look at 2001 to 2008. For basically 8.5 years there, the market did half of 1% return. If you're retired, you're basically spending your principal, spending it down.
Right. That's good. Good point. All right, Ernie, thank you so much for joining us today. We certainly appreciate it.
Thank you.
Hopefully we'll have a good outlook this year in the market. I know Zach Fradella